Hello, you are watching Trading Day on BNN Bloomberg. Intel is our first trending trade, and it's a real drag on the market, specifically the tech side of things. Intel's results are forecasted to be worse than expected in the current quarter. A slower recovery in PCs, trouble in the data centers. It is weighing on a number of semiconductor stocks that have actually benefited from the recent halo around NVIDIA. What do you do with a stock like Intel? Let's bring in Don Nesbitt, Senior Portfolio Manager and CIO of Equity Group at the Equity Group at ZCM. Thanks so much for joining me, Don. When you look at Intel, first of all, is this a name that you own here? And how troubled are you by the warnings that they have for the current quarter?
Hi, Amber, and thanks for having me on this morning. Yes, we've owned Intel in the past. We also we're out of the stock for some time, but now we are looking at re-entering into the stock. Intel is what we refer to as one of our classic bargain stocks. These are stocks that have, for some reason, whether it's in the industry, the company itself, have fallen out of favor with investors and have become neglected by them. As a result, their valuations, prices drop, the valuations become more attractive, and at some time you want to get back into these stocks. Of course, the kind of the follow-up on that is what we look for in terms of momentum measures. Are their earnings improving? Are the estimates moving up? Is the price action all improving? So Intel has been a neglected stock for a long time. There's no secret to that. I think when you look at in the tech sector, chips in general, it was one of the problem childs. But the catalyst for that change we saw in the last couple of years ago with a complete turnover in the executive suite and more of a refocus back towards the engineering basics of the chip industry. And so we were starting to see a rebound in it, started in about 9 months ago. And of course, this recent news has kind of been a little bit of a setback. But I think for the long term, in the long run, it's a great stock to own. It is more reasonably priced, and they are going to move into the same type of areas that competitors, as you mentioned, NVIDIA, which has been the hot stock in that area, others like AMD and so forth. Intel is moving towards that to become more of just a chip provider for PCs.
That's interesting. So would you look for that rotation maybe away from NVIDIA or even the AMDs to put to work in a more beaten up or neglected, to use your word, a stock like Intel?
Exactly, because NVIDIA, on the other hand, where Intel represents a bargain, a neglected stock that's been out of favor and is now starting to show promise of a turnaround. And again, this is over the longer term. NVIDIA is your classic glamour stock. It's been priced for perfection. I mean, it's done a couple of great things. It was in on the gaming chips. It was in on the cryptocurrency chips. But everybody else is catching up to them. Your Economics 101 basically says that excess profits cannot remain in a particular company without attracting competitors, and that's what you're doing. And as I mentioned, I think Intel is kind of in a rebirth of itself. It's turning around, and it's going to be more competitive in that areas. These higher speed chips associated with AI in the future.
On the other side of the ledger for the S&P 500, you've got American Express, and I'm curious how you think about that stock, which is just touching all-time highs.
Yeah, American Express is, we look at that along with its other financial service types, which is MasterCard and Visa. American Express is focused morely on the business user, whereas MasterCard and Visa are in the consumer end. And the story seems to be pretty good there. I mean, American Express has come out. It's said that expects growth, gave pretty good guidance. And relative to the MasterCard and Visa, it's trading at a much lower multiple. It's got a little bit of a higher dividend yield. But I think that takes into account the idea that American Express did have its business model challenged somewhat by the pandemic with the drop in business travel. Whereas obviously the consumer, especially once the pandemic lifted and they began to go out and travel again, they've benefited more from the higher consumer growth.
So are you sticking? Would you buy American Express here, given that it's at these highs?
Yes, I think we're holding it. Again, we're looking at its momentum features. It's beating. It's moving forward. So we're keeping a hold on that.
Let's talk the broad markets in general, how you're thinking about whether the momentum can continue. These new all-time highs that we saw this week, really underpinned by growth, right? Whether it's GDP, whether it's consumer spending that we got this morning at the same time that it appears inflation is falling.
Yeah, the economic background looks great, right? You've got a growing economy. You've got inflation coming down. It's a dream for, Jay Powell and the Fed. My question is, though, what is the incentive for them to cut drastically at this point? Employment numbers are good. Inflation's coming down. The economy is doing good. Why cut? When you look at where we're at with about 5.25%, 5.5% Fed funds rate, you got to understand that the market, when it talks about these cuts and looking for the cuts, is looking more at recent history, the last 15 years or so, where we've seen zero interest rate policies. And so, yeah, it seems like this Fed funds rate is high. But when you look at the 20 years leading up to the great financial crisis, which is the point then that we saw the drastic cuts and the move towards zero, the Fed funds is trading in that similar range right now. Interest rates were higher. You saw an average 10-year T-bill rate of about 6%. You saw economic growth at about 3% and inflation at about 3%. Now, the question is, what's going to happen going forward? So maybe we can make the 2% inflation range. Real growth, I suspect, is going to be slower. But even if it's at 2%, that to inflation to real growth would imply a 4% 10-year. That's about where we're at. So right now, though, when you look at the S&P 500, it's trading at a 20 multiple, or an earnings yield of about 5%. And that 5% earnings yield compared to the 4% yield on a treasury only gives you about a 1% equity risk premium. And that, it seems, very small. I think that equity risk premium is going to have to expand here. The past 10 years, that equity risk premium has been somewhere between 2.5% to 3.5%, call it 3%. So if you put that 3% on top of a 4% 10-year, you're talking about a 7% discount rate and a multiple that's better fitted for around 15 times than 20 times. The other thing then is earnings. What is going on with earnings? And right now, our expectations for earnings this year, 23 over 22, looks like about an 8% increase. But analysts are breaking in another 13% increase. And that just might be a little bit optimistic.